This is a bold call. It's not the top. There's a 180, there's a 185, but you're close to it and you're well above the average. What drove this?
Yeah, I mean, it's a little different call today than it was a year ago. A year ago, we were in a period of declining revenue growth, declining earnings growth. A multiple was, I think, approaching 10 times on the PE multiple. At the time, we were saying, like, look, if you return to growth, you can normalize that multiple up. That's been happening. And at the same time, the market multiple has also been rising. So, you know, with the multiple at 15 times, the question is, like, what's the catalyst to derail that at this point? There's a lot of anticipation building up for this new phone in September. There's maybe a difference where we haven't had a substantial difference since the 6 and the 6S came out. So it seems like the multiple can continue to creep up a little bit more, and if you look out a year and you look at 2018 earnings with growth, if they can deliver mid-single-digit growth, you can get more run out of the stock.
So let's talk about possible catalysts to derail, is what you said.
Yeah.
One of them, Samsung, coming back in. I mean,
sure.
they've had sort of a tough time the last few months, but they'll come back sooner or later.
There's plenty of catalysts to derail. I mean, the consensus estimate right now actually bakes in a belief that ASPs are going up, because a lot of the press stories have been about a $1,000 phone and people paying more. I mean, you go back to 2007, for Apple to maintain this level of average sales price on their phone is amazing, and now we're expecting, as a market, for ASPs to go up higher. So if the market pushes back on a $1,000 phone, that's obviously something that could derail earnings in the stock.
What's the idea of the price tolerance of the consumer to accept $1,000 for a smartphone? Where does this come from?
The idea is that this is the most important consumer electronic product of your life, and Apple is the one that you're stuck in, their ecosystem right now. So they're going to the wealthier people and saying, pay more. I mean, take a look at why would you pay $30 more for the iPhone 7 Plus? That camera doesn't cost $30 more. Apple's getting more profit out of you. So they're looking for ways to get more revenue out of their existing customers.
Neil, we talked earlier about financials taking a little bit off the table because they've just run so much, for example. What do you do about Apple sitting at record highs when you have Walter making the case for you? A little bit of optimism, but there's also some downside risk there.
Well, I think it's a very interesting stock, and I do think it's cheap relative to some of the other things you can own in the tech space. The reason I think it's interesting, maybe from where I sit, and I'd be interested in your response, is they are one of the beneficiaries of a cash repatriation. So I'd be interested how much of your price target allows for the share buyback that probably will come.
Right.
But I'd also wonder, Trump wants to make America great again. Its largest company could build the Apple iPhone in Pennsylvania or Minnesota. Right. How will they respond to the political pressure not to just put a sticky label on an iPhone before they sell it to the US consumer for $1,000?
How are they going to better questions than everyone else around this table?
How are they going to? That's the two things I think are going to be really interesting.
Well, I mean, what's interesting about the cash position is that they've been using it to turn declines in net income to increases in earnings per share, right? Because they're shrinking the share base. So they're borrowing money at a very low rate right now in order to use it. But there's a massive amount of cash. And even though they spent a ton on share repurchase and dividends, the cash balance has continued to rise to over $150 billion. So if there's a repatriation event, I'm not sure that companies are going to drop a special dividend. I don't think you do a one-time event, but maybe they take the dividend yield up to 4 or 5%. You could triple the dividend out of your free cash flow, take the dividend yield up to 4 or 5%. You open up a whole new class of investors that potentially take the valuation higher. I've seen this with AT&T and Verizon, companies that are struggling, that are holding on to their investor bases because they have a dividend yield of 4 and 5%.
Just to be clear, though, Walter, have you factored any of that into this call for 165?
None of that is factored into this call. In fact, I mean, if you looked at our multiple, our target multiple, that doesn't back out the $30 plus a share of cash that they have. That would take the multiple down to like 14 times relative to a market multiple of 18.
But to Neil's point about the downside, if you do have a call to say, hey, can you make your iPhone in the U.S., and then what happens when costs wind up going up, how do you think about that when you model Apple?
I mean, it's nice to be able to have all this cash and everything, but like if they're not growing, we've seen what happens to Apple's stock in the past when you go through a period where revenue goes into decline. And if there's a concern that you don't have this pricing power on the phone anymore, then you start looking at the gross margin. The gross margin has also been an amazing thing, holding up at 38% year after year. So these risks, it's still a tech company, right? I mean, you can't ignore the fact that things can unravel. But right now, it's a product that people want, that they're willing to pay a lot of money for, that holds margins up and gives revenue growth.